Hey everyone, welcome to The Explainer. So, we are looking at a truly fascinating disconnect in the market right now. Today, we're focusing our lens on Exponent Inc., ticker symbol EXPO. Look, if you just glance at their raw business metrics, the cash flow, the talent, their market position, they look like an absolute powerhouse. But then you look at how the stock has actually performed recently against the broader market, and honestly, you're kind of going to scratch your head. There's this massive tension right now between Exponent's stellar fundamentals and their actual market reality. So let's just lay out the data so you can see exactly what's going on behind the curtain.
Okay, here's our roadmap for today. First, the Exponent business model. Second, their FY25 financial performance and capital allocation. Third, stock performance versus the market. And finally, the 2026 analyst outlook and internal governance. Let's dive right into this.
Section 1. The Exponent business model, the foundation of the firm. To really get a grip on the tension happening with this stock, we have to look at what they actually do day to day. At its core, Exponent is a premier failure analysis consulting firm. Basically, think of them as the ultimate problem solvers for catastrophic engineering, scientific, and regulatory failures. When a massive industrial accident happens, or, say, a complex product fails out in the field, multinational companies, governments, and law firms call Exponent. And what makes them uniquely capable of handling this is their massive scale. They bring together over 90 different technical disciplines and have more than 950 consultants globally, so they aren't just guessing. They're applying rigorous science to figure out exactly what went wrong and how to fix it to make the world safer and more sustainable. Now, all of this expertise creates a huge, and I mean massive, competitive moat around their business. Just look at these 4 unique differentiators. First up, they've got an incredibly high concentration of PhD and MD talent. You really can't just replicate that overnight. Second, they actually own a large-scale testing infrastructure, like their massive facility down in Phoenix, which allows them to literally recreate and test real-world scenarios. Third, they possess a decades-long case library. Every single failure they've ever analyzed feeds right into a database that powers their predictive analytics, so they are getting smarter with every single case. And finally, their reputation is entirely built on defensible, peer-reviewed scientific findings. When Exponent testifies or drops a report, it holds up in court and under intense regulatory scrutiny.
Moving to Section 2, FY25 financials ends capital, translating those moats to cash.
So we know they have this incredibly wide competitive moat, but how does that actually translate to the balance sheet? Well, for fiscal year 2025, Exponent reported revenues of $582 million. That's a very solid 4.2% increase from the previous year. What that tells us is that despite any macroeconomic headwinds out there, the demand for their highly specialized engineering and scientific services just continues to grow. But hey, it's not just about top-line revenue, right? It's about what you actually keep. And in FY25, Exponent generated a really remarkable 28% EBITDA margin. That highlights incredibly strong profitability, and it basically proves that their premium positioning in the consulting market gives them some serious pricing power. And this brilliantly illustrates the full financial picture. Alongside that $582 million in revenue and the 28% margin we just talked about, they delivered a really impressive $2.07 in earnings per share for FY25. Plus, they're highlighting a super healthy balance sheet, strong cash flow generation, and the strategic agility to capitalize on high-growth areas. Honestly, this is the textbook definition of a fundamentally sound business. But here's what's equally important. What are they doing with all that cash? Well, they certainly aren't just hoarding it. Exponent actually has a history of aggressively returning capital to its shareholders. Just in 2025 alone, they repurchased $97.8 million of their own stock. That's about 1.35 million shares bought back. And, when a company buys back its own stock at that kind of volume, it's usually a massive signal that management believes the stock is undervalued and represents a fantastic investment for their excess cash. And this aggressive buyback is just part of a larger timeline of consistent shareholder rewards. Look at this. Back in October 2025, their board of directors authorized a brand new $100 million stock repurchase program. Fast forward a bit to February 2026, they declared a quarterly dividend of 31 cents per share. And they just recently reported their Q1 2026 results in late April, maintaining this really steady cadence of transparency and capital return.
All right, Section 3, stock versus market. This is where we get the narrative twist.
So, if you've been following along, you'd think they'd be absolutely crushing it in the market, right? But look at this stark visual divergence. We're tracking total stockholder returns from 2020 through the end of 2025. Exponent is that black line right down at the bottom. Through 2021 and 2022, they were tracking fairly closely with the S&P 500 and the S&P Midcap 400. But check out what happens from 2023 onwards. While the broader market indices, those gray lines, just march steadily upward, Exponent's returns actually decline. They visibly trail the market by a significant margin. So despite all those incredible fundamentals we literally just covered, the stock has been punishingly left behind in the recent bull run.
Which brings us to Section 4, the 2026 Outlook and Governance. External expectations versus internal reality.
This brings us to the final piece of the puzzle, which is Wall Street's reaction. Looking at the latest analyst actions from May 2026, this table tells you a lot about the current institutional sentiment. You've got top analysts like Tomohiko Sano at JP Morgan and Joshua Chan at UBS. Now, both of them are actually maintaining their underlying ratings. JP Morgan is holding a buy and UBS is holding a hold. But look closely at those price targets. In just a single month, JP Morgan slashed their target from $95 down to $80. UBS cut theirs from $85 to $75. Clearly, Wall Street is seeing something, maybe in the near-term macroeconomic environment or shifting growth expectations, that has them really tempering their enthusiasm, forcing them to adjust their models downward despite Exponent's undeniable cash flow. But we have to contrast that external market doubt with Exponent's internal stability. Because if you dig into their 10K filings, you will find they operate under incredibly strict internal corporate governance. Their insider trading rules are ironclad. They outright prohibit short-swing trading by employees to prevent people from just focusing on short-term stock performance. They enforce exceptionally strict trading windows for insiders, tied directly to earnings releases. And this is a big one. They strictly prohibit insiders from holding company stock in margin accounts or pledging it as collateral. So this is definitely not some speculative Wild West management team. This is a highly disciplined, risk-averse culture focused purely on long-term execution. Which leaves us with this final, really provocative question. We've got a company with a widening, near-impenetrable competitive moat, fantastic margins, and a management team buying back stock hand over fist, under strict governance. And yet, Wall Street analysts are lowering their price targets, and the stock is vastly underperforming the S&P 500. So, is the market entirely misjudging Exponent's true long-term value, or is Wall Street seeing a fundamental roadblock ahead that the trailing data just hasn't revealed yet? I highly encourage you to go look at their latest earnings reports and decide for yourself. Thank you so much for joining me on this explainer today, and as always, keep your eyes on the data.